Hello, everyone. Welcome to Lowenstein Sandler's Women in VC panel on Startup Math. My name is Alyssa Frederick. I'm a partner at Lowenstein Sandler in our Emerging Companies and Venture Capital Group. I am a corporate lawyer, and I'm joined today by several colleagues, Chandra Shih, Cicirelli, Bianka Barraza, and Chynara Tolubaeva. We are really excited to be gathering this group of our women investor and founder clients and other friends in the larger VC and emerging companies community for another session that is really fundamental to growing a company for profit. As those of you who have tuned in before to our Women in VC panels, our aim is to share some of the experience that we've gained over collectively many years of working with venture investors, founders, emerging companies, to help make you the smartest person in the room. So please feel free to drop any questions in the chat, and we will try to address them if we have time in the session. We're trying to leave some time at the end, and do give us feedback on what's helpful, what's not, and anything else that you'd like to learn about. So what we on this call from Lowenstein spend a lot of our days on is helping our investor and founder clients buy and sell parts of companies or entire companies. And of course, what you're buying or selling is a right to governance controls and financial value, right? Money and control. And in order to figure out what your governance and financial rights are, of course, you have to understand the percentage of the company that you're holding. You have to do math, which is not extremely complex, but one thing that's true about venture funded companies is you often have many stockholders, at least as you go through the stages, if you're selling equity to investors as a founder, and often giving equity to employees as well. And so it's important to understand how rights that you're offering will play out over time. Ultimately, most importantly, at the time that you are selling your equity, and possibly the whole company. So with that, I'll hand the baton to Laura and Bianka and Chynara to take us through.
Great. Thank you so much, Alyssa. I'm going to share the presentation. Just let me know once it's up. Can we see it?
Good.
Great. Well, hi, everyone. It's great to be here. We're going to just introduce ourselves quickly. So I'm Laura Cicirelli. I am counsel at Lowenstein Sandler, also in our emerging company and venture capital group. Bianka?
I'm Bianka Barraza. I'm a sixth-year associate in the ECVC group, and I primarily focus on M&A transactions, and I'll pass it off to Chynara.
Hi, everyone. My name is Chynara Tolubaeva. I am a quantitative analyst at Lowenstein. I work mostly for like pro forma modelings, liquidation models. So those are the bread and butter of the daily work. Thank you.
Thank you. So as Alyssa alluded to, we're going to be talking about venture math in general and kind of starting off all the way from formation and taking a company through an accelerated life cycle all the way through to a successful sale. I do not have a degree in mathematics, so don't worry, we will definitely make this understandable to the group. Great. So starting off at formation. So a lot of times we're working on laying the groundwork for the company. A lot of times the voting and the power, that all comes with what are your ownership percentages in the company. When you're a single founder, at formation, it's very simple. It's just you're going to hold 100% of the outstanding equity of the company. And the other thing that you're going to want to think about is at formation, most likely, if you're going to hire service providers and grant them some equity in the future, is putting in place an equity incentive plan where they will get grants out of, and kind of thinking about, well, how much of the company do you want to house in that equity incentive plan? Usually we see people say between 10 and 20%. On a fully diluted basis, and we'll kind of get to what fully diluted means in a second. But things are very simple when it's a single founder. Where we kind of come to some complexity is the idea of co-founders. So what happens if there's two or more people coming together to form a company? A lot of times there's an assumption, and it's not always correct, that everyone needs to have an equal equity split. So 2 co-founders, that means it has to be 50-50 split between the 2 of you. That could be the case, but it's always, not always necessarily the case. So there's a lot of different facts and circumstances to think about. A lot of times it's very normal to have one co-founder be more of the lead co-founder, if you want to say that, where they maybe get 60% of the company and the other gets 40%. So it's something to think about. The one thing to also think about and be cognizant of is that if you have a 2-person cap table at the beginning of formation and each of you have a seat on the board, what happens in the case of a deadlocked board? So you want to approve something, you both disagree, and you can't get it approved by a majority of the board because it's split 50-50 at the board level. Now at the stockholder level, we're also split evenly 50-50, kind of at a stalemate. So we advise clients a lot on that situation, and just something to be cognizant of if you do have a single co-founder and you find yourself in that potential situation. There's 2 terms that we use often and we will use often throughout this presentation that I kind of want to just lay the groundwork for. The first is when talking about your ownership percentage. A lot of times we say fully diluted ownership percentage. What does that mean? That means assuming that everything on the cap table is converted to common stock. So we're comparing apples to apples. What do you own in the company? And we have a model on the next page to kind of talk through this. But assuming, for example, that everything that's issued or reserved under the equity incentive plan that we put in place, assuming all of that is actually issued and exercised by service providers, what does that mean for your ownership percentage? So it really gives you as a founder a look into what is the potential dilutive future that my equity holds should all of these things on my cap table be actually exercised or issued. What does my ownership look like? The other is issued and outstanding basis. So this means based on what's actually issued and outstanding to date, what do I hold in the company? So those are 2 terms that we will use often. And on the next slide, we have a very quick model here to just show this. So
Can I just
comment
on the use of fully diluted? So that's a really important definition to keep in mind whenever you're negotiating with anyone, whether it's an advisor who's going to get a small equity stake and you're talking about the percentage of the company they're getting, maybe it's 0.1% of the fully diluted equity of the company. But what is included in that definition will determine how many shares they actually get. The same thing if you are an investor or a company selling stock to an investor, what is included in that definition of fully diluted is really important. And that's something that we work through a lot in term sheet negotiations, but just something to keep in mind because you always want to crystallize the percentage of the company that you're selling and know exactly what that is. And some of the biggest problems that we see for companies run into early on is when that is not clear and percentages of the company are offered and they're not fixed in time, they're not crystallized into a number of shares. And you never want people to be out there, with a claim to a larger piece of your company than you meant to give them, or thinking, that they were supposed to get a larger piece of the company.
Yeah, exactly right. So this is just a quick model of a fake company that we put into place, and this company will kind of trickle through the models that we have on this presentation. So we have 2 founders here. We're doing an even 50-50 split between the 2 of them, despite what I just said on the last slide of being cognizant of if there is a stalemate. Just for simplicity purposes, we have them as 50-50 on an issued and outstanding basis. So if you see, everything that's issued to date is going to be collectively 9 million shares. They each hold respectively 50% of that. However, on a fully diluted basis, here we have an equity incentive plan that's not issued to anyone, but it's just there and reserved for any future hires that you want to, bring people on board and issue them equity under the equity incentive plan. It's there and it's 10% of the company, but nothing is outstanding under that plan yet. So outstanding basis, they each hold 50%, but on a fully diluted basis, we assume everything outstanding under that equity incentive plan in exercise, even though it's not, and they go down to 45% each, and the equity incentive plan is 10%. So just a quick model there. And this slide just goes to the next step of your journey, which is onboarding. Service providers, which is kind of what Alyssa was referring to, is now we want to grant people equity, and we need to be cognizant of how much are we actually giving them. Early stage companies, a lot of times when they onboard advisors, the only form of consideration or compensation that they'll be giving them is an equity grant under the equity incentive plan. And a lot of times we get asked, well, what's a normal size grant? It depends on a lot of facts and circumstances. Early stage, if you're looking in the range of 0.1% to 1% of the company on a fully diluted basis, it's not in the range where any red flag is going to be raised. A lot of times, if you see things like 3%, it's not a no-go, but it's certainly going to be someone that's very important, and it needs to be crucial to the company to have them onboarded at such a large grant size. As Alyssa discussed, a lot of times business negotiations will be based on percentage ownership of the company. It could be on an outstanding basis, could be on a fully diluted basis. Usually we'll see service providers ask for fully diluted basis for the same reason we talked about on the prior slide, is they just want to know, after all is said and done, assuming things are all issued or exercised, what is really going to be my ownership stake in this company? So that's why we use the fully diluted basis. Even though the negotiations happen and we talk about percentages, it is absolutely crucial, and this goes to Alyssa's point, that we put the actual share number that these service providers will be getting in their definitive documentation. So in their offer letters, in their actual grant documentation, we're not going to say 1% of the company on a fully diluted basis. We're going to say 50,000 shares, for example. And that's very important so that we don't have anyone in the future opening up to arguments saying, no, you calculated it wrong. This was supposed to be included in the definition of fully diluted capitalization, and it wasn't. Just setting an actual share amount is so, so important. So we have here on the next slide an example of onboarding an advisor. So here you'll see we have the same two co-founders. Their ownership stake has not changed. We have someone coming on board for 1% of the company on a fully diluted basis. So their grant size is 100,000 shares. And so what you'll see is the founders, their fully diluted ownership percentage hasn't changed. What we've done here by issuing something under the equity incentive plan, which has already been reserved and set aside at formation, is we changed that equity incentive plan pool, and we decreased it from 10% to 9%. And that delta, that 1%, is now just going to be held by the advisor. If you look at the outstanding share column, this is an important point that we get asked a lot. You'll see that the outstanding share number is still 9 million. So each of the founders on an outstanding basis still own their 50% interest each, which means for things that require voting, they hold 50% of the voting power each. Options are not going to be deemed issued and outstanding as shares until such point in time as they're exercised by the option holder. And that is when those options will move from the options column over to the common stock column. And then the outstanding ownership percentages will change as well at that point in time, but not at the point that the option grant is issued. So now we're getting into a bit more of the complexities of things. So usually startups, when they take in their first outside cash from investors, a lot of times it'll be done through convertible securities. So most often we see either convertible notes or simple agreements for future equity, or SAFEs. For purposes of this presentation and this slide, we're just going to assume that this company is going to issue a SAFE. The biggest difference, just talking about the two different types of instruments that we often see, convertible notes are treated as debt, while SAFEs are not. They're treated as equity for tax purposes. So in a sale transaction, which Bianca will get to later, any type of debt, including convertible notes, if they're outstanding at the time of the sale, will be paid out first prior to anyone who has preferred or common stock. Whereas safe holders are going to be paid out at the same time as any preferred shareholders are paid out. So that's a difference. As a debt instrument, the convertible note also has interest accruing underneath it, and that'll kind of come into play, and we'll see that in action in a couple of slides when we have a pro forma for a price round. We'll see how that works. But so these are the two types of general instruments. Quick math on SAFEs. So there's different types of conversion metrics as to how these instruments, both notes and SAFEs, can convert. It can either be a straight discount rate. So that would say in the next round, whatever the price per share in your preferred financing round is, you have to pay, or you get a price per share of a 10% discount. So if it's $1 in the next round and you have a 10% discount, you come in at 90 cents per share. So that's how the discount rate works. There can be a valuation cap. Usually we see nowadays post-money valuation caps, but you may have in the past seen a pre-money valuation cap. For purposes of this presentation, we'll just kind of talk about the post-money valuation cap because it is market today. Quick math on that and what that does. So when this converts, even though in the price round, so when you have preferred stock being issued in the price round, which we'll get to in a few slides, whatever the valuation is in that round, we disregard it. The valuation cap in this safe is what's going to be used to determine the price per share that these safe holders will come in that round. And we'll walk through a model in a couple of slides so that actually makes sense. But that's the idea of the valuation cap. Or you can have a convertible instrument that has both of these metrics, so the percent discount or valuation cap. And what happens is the investor gets the benefit of, at the time of conversion, whichever one yields to a lower price per share for them, they get to use that price. So there's a lot of different ways that these things can convert, and we just need to read the document to make sure we understand that.
And Laura, before you jump in, hi everyone, Chandra Shih. I'm a partner here at Lowenstein in our ECVC group. Thought maybe we could talk for 30 seconds about why the market has shifted from a pre-money valuation cap safe to a post-money valuation cap safe. The pre-money cap safe was sort of the standard put out by Y Combinator and other folks when the safe was first originated. And it was certainly a metric that we all are used to seeing in term sheets generally when you're talking about even priced preferred financing rounds, right? We talk about things on sort of a pre-money valuation basis. YC several years ago moved to a pure post-money valuation cap safe and eliminated the pre-money cap. And the real driver there was that investors wanted certainty at the time that their safe was being issued, that they knew what percentage essentially they were getting of the company. And with safe instruments, there aren't sort of blocking rights over the company's ability to go out and issue other safes. You might have sort of a pro rata right, but oftentimes we see companies utilize safe instruments and issue just a bunch of safes on sort of different valuation caps over time, sort of extending their safe rounds continually. It was leading to situations where people were going, hey, I put my money in early, I risked my capital early, I thought I was buying something, but it turns out, I was buying something else because you went out and issued a bunch of other safes. All it does is it shifts the dilutive effect of those additional safes you're issuing into the existing cap table, rather than asking your safe holders and other investors to sort of bear dilution for those later safes that you've done. What they're basically saying is, I'm buying my percent of the company at this price, no matter what else you do, and I won't stop you from doing those other things. But you, existing cap table, mostly you, the founders, right? You're going to bear the brunt of that extra dilution. I will not, I never feel like I can emphasize this enough. Whenever you are either investing in a safe round, or if you are a company who is doing a safe round, and you are the founder of that company or someone early at the company with a significant stake, please always model out what that round looks like when that safe converts on the valuation cap that you've given. It can actually be a super meaningful thing. And we see so many companies and founders sort of get burned by this, where they don't really realize the impact. And then all of a sudden you have the happy situation of doing a financing round and realizing that you're being completely wiped out. And now you have to deal with, how do I refresh my equity? So, I think it's a really important piece for everyone here to just keep in the back of their mind whenever you're seeing that.
Yeah, thanks, Chandra. That's actually the next point was just our team, Chynara and her team really help us in so many situations with building out models for clients before they issue another series of safes to say, hey, can we model this out and put in a bunch of variables that we can kind of play around with, assuming the next round has a valuation of X, what happens to all these things and what does my ownership look like? We do that all the time, and it's so important. Actually, the bottom of this slide has a link to an article that Lowenstein put out And please, it's going to be put into the chat. Please take a look at it. It has a lot of detailed models of that very scenario of the pitfall of issuing a lot of safes and different series of safes and just not knowing what's going to happen when those things convert. What does that look like for me as an existing shareholder of the company? So it's a really good article to take a look at. We also have a couple of examples of just very simple math based off of kind of what Chandra was saying with the post-money valuation cap safe. So in our model for this presentation, we're going to assume that we issue just one safe at $50,000. So someone invests $50,000 into the company, and that instrument has a valuation, a post-money valuation cap of $6 million. Kind of what is that math that we can do quickly to see what is that safe holder going to own, what percentage of the company when that safe converts. And the way to do that now on the post-money basis, we know that it could be $50,000 divided by 6 million, which is about 0.83% of the company. And that doesn't account for the idea of that's going to be diluted by anything in the round, like the new money investors. And if there's any equity incentive pool increase, we'll talk about that on the next slide in connection with the round. The safe holders will get diluted by that. So the 0.83% will not be what they own at the end of the day, but at least at that point in time when the safe converts, prior to the new money coming in, that will be what the safe holder holds based on this term for a fraction of a second before the new money comes in.
This is something that is so key and that just really at a very basic conceptual level. When you are selling equity, when you're the company or the founder, right, you want to sell a very definite percentage of the company as it exists today, right? That was our advice about when you're issuing advisor grants. But when you are buying equity, when you're the investor or the person who will be receiving the equity, you want to think about how much you could get diluted in the future. And the safe is an example of a security that is not a definite percentage of the company. It's basically selling a percentage of the company as it exists in the future, after the company has issued more securities and diluted the person who's buying the equity that day. And then also when we'll talk about preferred equity financings, there's some of that too. When you're the investor, you want to talk with the founder about how much equity they're going to need to issue to employees in the future. And you might want to build that dilution into your price.
I just want to stop for a second. There's a few different questions in the chat. And so, I think first on the questions around the safe rounds, and, I think Laura will have a model that will show that sort of shows how these convert. So some of this may be addressed there. But in situations where folks are raising safes or other convertible securities at different valuations, and if they end up raising sort of less than they're anticipating raising, for the post-money safe purposes, it kind of doesn't matter. If you end up being the only safe, you're buying your sort of fixed amount based on a certain valuation. And so you sort of operate independently of everyone else. It impacts dilution for the existing cap table, but not for your sort of ownership stake that you think you're getting as an investor. Now, if the future round is such that it's at a lower valuation than even your valuation cap was, then you're sort of coming in as though you were plain dollars in that round. You get the benefit of that, just whatever that sort of standard preferred price is. We have a question about what the average valuation cap is that we're seeing at the pre-seed stage for post-money caps. So I always think it's a little funny that we have this concept of an average or market valuation cap, because I think that it is so heavily dependent on the company and the round at which you are hoping this safe will convert. And so I always like to ask the question of, if and when this safe converts in your sort of roadmap as a company, what does the round look like that you're raising, the preferred stock financing round, where this is actually going to convert? And if you tell me, well, everyone says a 5 or a 10 million post-money valuation cap is market, but that you're not going to raise a Series Seed or Series A financing round unless you've got a term sheet for a $50 million, post-money valuation, there's a really huge misalignment between the valuation cap that you're using in your safe and what you are expecting that safe to convert into in your actual next round. And so it really, really, I think you need to kind of think about it like a game of chess. if you're trying to think 2 or 3 steps ahead, where does this actually land us? It shouldn't be a proxy for the value of the company today. And one of the main reasons that you're doing a safe is that you don't want to have to figure out what the value of the company today is, right? And so I think trying to have it be a proxy for that is problematic, and you're selling yourself short as a company, and as an investor, you're sort of really becoming misaligned with the round in which you will convert into. And it can throw off voting dynamics and, you know, dilution and all that other stuff. Really, the valuation cap should be viewed as a backstop in a scenario where the company has sort of the good fortune of being worth a lot more than anyone was expecting, or in situations where the company has just chosen not to convert the safe for some reason, or to put off doing a round until it's worth significantly more than it anticipated. But I always think if you've got a valuation cap on a safe and you're not intending for that safe to convert until the round size is like 2, 3, 4x the valuation cap that you've got, there's a problem there, right? And so I would hesitate from just assuming it's one size fits all. The last question that we had in here was, you know, what options does a founder have if a founder leaves after the 1 year cliff? That's a little bit more nuanced, and Carmen, we can maybe chat about that separately if there's more there. But in short, when folks are leaving and they haven't yet vested through all their securities, you sort of get to keep what you've vested through, and the remainder would fall away. Sometimes there can be negotiation around an exit, particularly for a co-founder, to accelerate some portion of it, right? Or there can be sort of a trading of horses a bit there, but outcomes really can be custom and depend on the situation, and it depends on what your current paperwork said and all that good stuff.
I think that vesting point is a really essential one for founders, because, you know, investors are, it's always in the interest of investors for founders and other employees to have vesting, because if people leave without putting in that sweat equity that, you know, the investor is expecting, then the presumption is they shouldn't be taking all of that equity away. But it's important for founders too. If you have co-founders, it can really make or break your company's ability to function at an early stage if you don't have appropriate vesting on your co-founder shares, and that co-founder ends up not being able to or wanting to stay and put in the level of commitment that you are. So it is good to make sure that you're talking with your lawyer too, just to understand what the rights are when that person leaves. Because as Chandra said, the venture funded company standard is when somebody leaves, they keep their time-based vested shares, but they lose the rest. In more traditional private equity funded companies, there's usually a right to buy back all of their stock for some price, but that's not the norm for tech companies that are going to go after venture funding.
Mm-hmm. And last question we just got in the chat for, you know, have safe funded startups faced more issues with raising money or with investors? You know, what does that look like, and how can safes be made more lucrative for investors in the current scenario? So a couple of things. One, I don't think that safe funded startups face more issues with raising money, but we do see some startups utilize safes for too long and to raise too much money, which then starts to put pressures on the economics for your actual priced round to convert those safes. And so I always caution people, you know, if you're going to do a safe round, be really purposeful about it. Think of it as a moment in time. Don't have it be this sort of evergreen thing where you are continuing to raise for years and years on safes and for millions and millions of dollars, because it just, when do you know is the right time to convert all of those things? And the dilutive effect can just be really monumental to your cap table, and it takes the right investor who's going to want to come in and price around, deal with all the special voting mechanics that you're going to have created with this dynamic, and also help get founders sort of re-incentivized by giving them more equity at a higher price, right? How do safes, you know, how can safes be made more lucrative for VCs or investors in the current scenario? You know, I think that anytime you're putting capital in early and you're taking a risk on a company, you're getting the benefit of a discount, or you're getting the benefit of a valuation cap that, you know, could provide you with some good outcomes that are better than other people who put their money in later when you've sort of fronted the money to de-risk it. I don't know that there's huge mechanisms for making them quote unquote more lucrative for VCs or investors. depending on how much you're asking for there, it can start to, be less of a positive instrument for like the companies and founders to want to use. Certainly in riskier situations, or situations where you're not sure a company's going to be able to raise a next financing round and actually convert that safe. And so maybe exit sooner is more likely, like a M&A exit. We sometimes see people ask for multipliers on, your cash back on a change of control. And so there are things like that where you can try to sort of assess risk and figure out the right way to address it. But it's just really going to become, it's part of the nuance of the deal. And one of the reasons people use safes is that they're so standard, and the idea is not to customize them, really. I think once you start to get into super bespoke terms, it changes the nature of the deal, and that's fine. Certain deals may necessitate that, but by and large, when people are talking about doing safe rounds, they're really expecting them to be what I would call quote unquote plain vanilla and on the sort of YC form terms, and not heavily modified.
And I would say that despite the, we've had a real down market in venture, and for a while things are coming back, but I still see safes all the time at the early stages. We're seeing a lot of them. When you might want to, but at the other end, when a company is, and it could be at an early stage, but when a company looks like it might not be able to raise new outside capital that was expected to be needed, and existing investors are bridging a company, and it might be a bridge to nowhere, that's when thinking about taking a convertible note, which is actual debt, which will be treated like debt ahead of equity in a liquidation, becomes more important for the downside protection there. Then you have the interest, and you, as an investor, you have the leverage to basically take the company into a liquidation at the maturity date if needed. So we see a lot of convertible notes in those types of scenarios when it's not as optimistic.
And I know we are woefully early in our presentation still. So Laura, why don't you take it back and let's try to breeze through some of this to get to the next content.
Please keep the questions coming. They're great. So the next stage here, we're going to go to the price round. So this is really where we're going to get a term sheet. We're going to get a lead investor. In connection with the round, we're going to issue preferred equity of the company. The first round of financing will usually be called the Series Seed preferred financing. And this is when all the convertibles that we've been talking about, those safes, any convertible notes, will convert into a sub-series of this new round. The reason it's a sub-series is going to because it's going to have a different price per share because of the discount mechanisms than the new money safes. So what we did here was we took the relevant provisions at the bottom of this slide. You see the amount raised in the pre-money valuation paragraphs. We took these paragraphs out of a standard term sheet that you'll see for a price round. And we want to kind of on the next slide, build out a model to show you what does this actually mean numbers wise for our fake company that we've been working on with the two co-founders equally split. So in this round, we're assuming that we're raising $1 million of new money. So that's excluding anything that we may have raised through convertibles to date. And what is the valuation of the company? The fully diluted pre-money valuation of the company will be $10 million. And what do we mean by fully diluted pre-money valuation? We'll show in the model on the next slide. But what's included in that pre-money valuation? It includes, as you see here, a 10%, what we call an equity incentive plan refresh, you'll often hear it called. But what it is an increase to the equity incentive plan so that as of after this round is done, 10% will be available under that pool for future hires. And investors often ask for this to make sure that they don't close this round. And, within a few weeks, the company says, we have a hiring need. We need to increase our equity incentive plan. Now the investor's on the cap table and they're going to be diluted by any increase to the plan. They don't want that. They want the dilution to happen to anyone who's existing already on the cap table, not them. So that's why it's taken into account in the pre-money. And we'll show that on the next slide as to kind of what does this all mean in practice. I'm going to just kind of skip to the model because I want to be cognizant of our time. So here we have the model. We have the same two founders. As you'll see, they each hold the 4.5 million shares. We have that same advisor who holds his or her 100,000 shares. And we have in this row, the current unallocated option plan is still at 900,000 because we didn't change it. So this plus this is what we originally had, is at 10% reserved at formation. And so now for purposes of this model, we have our original safe that we talked about, the 50,000 on the 6 million, but we also added a note just for illustration purposes. There's the same conversion mechanisms in the note. They both have a post-money valuation cap. The only difference that you'll see, and the reason we wanted it in this model is to show the real difference between the convertible note and the safe, assuming all of their terms are the same, is that there's interest accruing under this note. So you'll see that means that actually the shares that it converts into, even though there's all the same original principal amount and valuation cap, it's actually going to be slightly higher because we also have to account for the additional about $5,000 of interest that's been accruing there. So how do we kind of come up with the price per share for these safes? And we kind of talked about it quickly on the other slide, but now when you do it math-wise here, you take this valuation cap. It's a post-money valuation cap, so you can read the safe to see exactly what's included in that denominator here. But because it's post-money, that means that everything issued and outstanding at the time of this round, so the founder's shares, any type of shares that are converting because of other securities outstanding. So here the total is the 177,000 shares from both the note and the safe. Those are included in that denominator. Any type of options outstanding are included, as well as anything that's currently reserved under the plan. We don't include any type of top off that's going to be done in connection with this round, but just what's actually reserved at the time of the round. And in the safe document or in the convertible note document itself, this idea of what is included in the fully diluted definition, as Alyssa said before, will all be laid out there. So it's a very negotiated point in convertible notes and these convertible instruments. So that's kind of how you get the price per share. And you'll see it's less than the new money price per share. And how do we get to the new money price per share? It's in a very similar manner. We take whatever the pre-money valuation is, as per the term sheet, it's 10 million. And kind of now, what do we include in this denominator as per the term sheet? We include everything that's issued and outstanding to date at the time of this round. So everything that's included in the denominator for the safes. But in addition, we're going to include the equity incentive plan increase, because as per the term sheet, if you remember, it said that it has to be 10% on a fully diluted post-money round, 10%, but it's included in the pre-money calculation. So a lot of pre and post, but that's really going to be the difference, is that denominator is going to be larger there because we include that increase.
And two things there just for you to think about, everyone listening. The reason that a lot of investors ask for the option pool increase to be included in the pre-money is because the way that translates is they are saying, we want you, existing cap table, to be the ones to bear the dilution that comes for any grants you're going to be making under this increased pool. We understand that you're going to take our money and go hire a bunch of people and make grants, but we want you to sort of be the ones who take the hit on the dilution for it, and our dollars are going to come in on top of that. If in the future there are increases to the option pool plan, everyone on the cap table, including that investor, will bear dilution for it. But basically for this pre-negotiated amount, we don't want to take a hit for it. That's the way that that kind of works. It's not always a guarantee that the increase to the option pool comes in the pre-money. It's definitely a negotiated term, but we do see it very frequently. The other thing I'd mention is that because the math on how you're coming up with the purchase price for the new money and the math with how you come up with the conversion price for the safe or the note is slightly different math, people get confused sometimes if their note or safe has a $10 million valuation cap and their round has a $10 million valuation cap, but the price comes out slightly differently. It's because of this math piece, right? And so sometimes we do things to try to align it, or you play with the economics or whatever, but just know that it doesn't automatically mean everything will have the same price.
Yeah, exactly. And so the last point on this slide, and we're going to turn it over to kind of the M&A side of things, is this column here we added about the implied value. And I wanted to quickly talk about this because a lot of times in a term sheet, a founder will say, oh, the pre-money valuation is 10 million. That's great. But really, that's not what the implied value is once you kind of subtract from that all the things that we talked about that are included in the pre-money valuation, which will affect and therefore lower the price per share that the investors are paying. So for example, here we have securities outstanding, the convertible securities outstanding. Those are taken into account as per the term sheet in the pre-money valuation. What that means is the value of those converting securities. Here we take the number of shares of this new Series C that they convert into and multiply them by the new money price per share. That value is taken into consideration in the pre-money. So it actually works to reduce that 10 million number slightly based on that value of the convertibles. Then also the increase to the equity incentive pools included in the pre-money valuation. We are increasing that pool by about 250,000 shares. When you take that based on the value of what the new investors are paying per share, you also deduct that value from that 10 million that we saw in the term sheet. So that really gives us an effective implied valuation, pre-money valuation of about 9.5 million, which may not seem like a huge delta in this very simple situation. But as we talked about, we see companies that issue safes and convertibles for millions and millions of dollars. That's when the term sheet valuation that you see may not be exactly as it appears on paper, and always make sure you think about what's actually included in that valuation and those deductions that need to be made to get me to my implied valuation for purposes of determining the price per share that these new money investors are going to be coming in at. So this was really the math behind the price round. In connection with the price round, you'll have your certificate of incorporation of your company amended and restated to kind of layer in all of these new securities that are issued and all of the mechanisms by which, when the company sells, how do we pay out proceeds to all these different types of equity holders that we now have on the cap table? And that's kind of where it pivots over to Bianca's side of things.
Can I just add one note? A question: where does all this math come from? It comes from, if you're doing a priced equity round, the term sheet will in very simple language lay out the formula that you have to use, and that interacts with the safes that you may have already issued and the language and the formulas in the safes, right? But a lot of what we do as lawyers is when we're negotiating term sheets, we'll read them and advise you on what the formula is, because it's not necessarily clear, right? And then add language or take away language to make sure that you're actually selling or buying the percentage of the company that you think you are.
Okay, so I'll talk a little bit about the implication in an M&A transaction. We're kind of limited on time here, but I'll try and cover kind of high level, both the distribution of the proceeds, and then also we'll get to the calculation of the purchase price, and then some adjustments that can impact the kind of headline purchase price. So when we're thinking about the distribution of proceeds, Laura had kind of touched on this a little bit, but one of the first considerations is, what the company's existing cap table looks like and who the stakeholders are in the transaction. So essentially, who's going to be entitled to proceeds. And so that could or does vary company to company, depending on, what the cap table looks like. There could be different classes of stock in common and preferred, different series of preferred, which are going to then be entitled to proceeds based on seniority of the preferred. There could be convertibles still on the cap table. As Laura mentioned, notes are treated as debt for this purpose. So depending on the amount of the proceeds, there could be situations where the notes are receiving proceeds and shareholders are not. And then also, typically we'll see option holders on a cap table, potentially warrant holders. And so some of the considerations there are, the reduction of their proceeds based on their exercise price. So who are the stakeholders? Also, what does the company's existing charter say? That's typically going to govern how the distribution works in the transaction. Depending on the situation in the transaction, there could be, kind of agreed changes in how the distribution is going to work, but typically that's what you're going to follow. And Laura had mentioned liquidation preference. Typically, the NVCA charter is going to, the company charter is going to follow the typical NVCA charter, where the preferred is going to be entitled to the greater of their liquidation preference, which would typically match the original issue price per share, or the proceeds that they would be entitled to if they had converted the common. And so it's really just dependent on the outcome of the transaction, what the aggregate proceeds are available for the shareholders. You may also see participating preferred in a charter. In that case, the preferred is going to be entitled to their liquidation preference first, and then they'll be entitled to share in the remaining proceeds for the remaining shareholders. So they'll share pro rata with the common holders the remaining proceeds. And then lastly, the overall value of the transaction, of course, is going to impact who's receiving proceeds. Depending on the situation, if the aggregate proceeds are not enough to cover the liabilities of the company and the liquidation preference, it may be that the common is out of the money. And so common holders, option holders, potentially warrant holders who have warrants to exercise for common stock may not be entitled to proceeds. In some transactions, the board may determine that it makes sense to set aside proceeds for common, but that's typically not going to be the route in that case. So we have a few examples.
And
This
Bianca,
next,
can I just say one thing on that?
Sure.
Part of determining so your charter document is going to lay out the formula you need to follow for how to pay out the liq pref. But what Bianca's talking about is that in certain situations where, you know, common stockholders and other people around the cap table are really not going to, based on that formula, be entitled to any of the proceeds. Sometimes folks in the boardroom and preferred stockholders will want to both incentivize management and other people around the, you know, at the common stockholder level to, you know, do the transaction and also get a little bit out of it by changing the default way in which you're going to pay it out. But also from a risk perspective, there can be real drivers for wanting to make sure that a broader set of stakeholders in the company are actually seeing some of the proceeds, especially depending on the way the board's constituted and whether or not everyone in the boardroom is sort of interested. And so we don't have enough time in this session to go into the drivers for all of this, but just please know that this is a really important inflection point. And I think people wear a lot of different hats as board members, as controlling stockholders, as, you know, management, and it can create a lot of conflict and a lot of risk. And so managing these numbers, managing the exit process thoughtfully becomes really important. And in terms of, you know, management carve out, I see something in the comments about that. I don't know that there is a market management carve out that gets adopted. It really depends on the economics of the company. For those who don't know, a management carve out is essentially a cash bonus that can be given to management in connection with an exit, even in situations where like common stock isn't going to participate. But you know, it's taxable at ordinary income. You're not seeing capital gains on it. It's a really common tool that you can use, but there's so much that goes into the nuance there.
and then I'm going to go through we have 4 examples laid out here, but I'll kind of talk high level about them. They basically just lay out different kind of economic situations. The first being the one we sort of just spoke about, which is where the common and options are out of the money. And the next one is there could be a situation where the common is in the money, but certain option holders are out of the money or certain warrant holders, and that's really in the event that their exercise price is greater than the per share consideration. So in that case, you may see certain common holders receive considerations and maybe some option holders, but not necessarily all option holders. And again, there's a lot of nuance here. There's a lot of negotiation that happens. So there could be various carve outs or retention packages that could pick up, you know, kind of the difference if this is the case. These models are really kind of simplified versions just to outline how the distribution works. In the next 2 models, this is kind of like the home run situation for the company where the aggregate proceeds are in excess of liabilities, liquidation preference. And in this example specifically, we show the impact of the preferred being treated as converted to common because that is a better outcome for them than receiving their liquidation preference. So this is kind of the most straightforward model here because then everyone is treated as though they are a common holder and shares in the proceeds pro rata. In the next slide, we lay out the scenario where there's participating preferred. So the economics here are the same, the value of the company and the adjustments, but the distribution is different. So really you'll see the difference in the amount of proceeds that the preferred is receiving and the decrease in the proceeds the common receives. And again, this is really because the preferred is going to get the benefit of receiving their aggregate liquidation preference, and then on top of that, being able to share in the proceeds that are remaining with the common pro rata. So it can have a big impact on everybody's proceeds.
If you are a founder considering accepting a term sheet from an investor that's asking for participating preferred, I highly recommend doing a simple waterfall for yourself to see how that plays out in different valuations and exit scenarios.
So we can go to the next slide. So I'm also going to touch a little bit on the calculation of the purchase price and how that can be adjusted depending on the terms of the transaction. Oftentimes, you'll see in an LOI, it'll have the enterprise value, which is the value that the buyer is willing to pay for the company. And it might include language that says that they're acquiring the company on a debt-free, cash-free basis with a normal level of working capital. And essentially what that means is there's going to be a purchase price adjustment built into the purchase agreement for variances in each of these metrics. So in terms of these individual metrics and how they affect the purchase price, each of these terms is going to be a defined term in the purchase agreement, and each one is negotiated in each transaction. And depending on the company, depending on the business, some may be more impactful than others. Cash typically is going to be a positive adjustment to the purchase price. So the amount of cash that the company has on its balance sheet at closing would be a direct dollar for dollar increase to the purchase price. So of course, that's a benefit to the equity holders. Oftentimes we'll see buyers try to carve out restricted cash. So again, depending on the business, that may or may not be relevant for the company. If there is a lot of restricted cash, which could include security deposits for leases, that could be carved out as excluded from the calculation of cash. So those are the kinds of things that we, as the lawyers, are going to talk through with the company to make sure that the items that are being included or excluded from each of these are either not significant to the company, or if they are, we'll want to negotiate what's included. Indebtedness is a big one. Definitely heavily negotiated, a very extensive definition. It includes a lot more than people expect. Generally, when we talk to founders and companies, they are expecting, their bank loans, guarantees, those kinds of typical loans or debt to be included, but they might not realize that the buyer's oftentimes going to try and include deferred revenue. And if that's significant for the company, that'll be a negotiation point, or unpaid compensation, just different things that people don't generally see as true debt. Other adjustments are...
Sorry, I just wanted to say, a lot of these things can make a big difference. So check your waterfall. If you are talking about a headline purchase price, make sure you're understanding, is your debt facility included there? Have you told whoever's making the waterfall how much debt is outstanding? What is the banker fee? That can be millions of dollars. Just making sure that you're really understanding what gets pulled out of that headline number.
Exactly. And pretty much the same concepts with transaction expenses. It is a direct purchase price downward adjustment. So as Alyssa said, you definitely want to understand what that's going to be. And that'll include, all the expenses related to the transaction.
I'd also say for any M&A, people always want to have M&A activity be as simple as possible, but it is never cheap. Even the simplest, cleanest, smallest sort of asset sale or asset purchase or a full-blown sort of merger, all of it comes with much higher transaction expenses than I think people are anticipating. And part of it is just the fact that you've got folks separating at the end of the transaction and allocating risk to each other. And there are a lot of moving pieces, and there are often a lot of additional pieces of paperwork that go into these transactions that just make them much more cumbersome. And so transaction expenses can become a really big part of it. Don't be surprised by that.
Definitely. And the last one is working capital. That's really going to be an adjustment based on an agreed target. The target is another negotiated point. We want to make sure it's something that makes sense for the company. And so oftentimes there's a lot of discussion about that. And I know that we're out of time now. So I guess I'll close it out. The rest of the presentation is really about other deductions like escrows and holdbacks and that kind of thing, which we can probably talk more about later.
Yeah, I think one thing we could do is have a separate session on sort of M&A math and exit waterfall stuff, because it gets much more complicated. There's so much more nuance. And so we can definitely do a part 2 to this. But thank you everyone for joining today. Hopefully this was a helpful primer and overview. If there are specific topics that you're interested in or things you want us to dive deeper on, always feel free to reach out, and we will share a copy of the presentation. We will share a copy of the spreadsheet, and we'll try to schedule a part 2 of this so that we can dive even deeper on some of it. So thank you all. Have a great day.